You wake up in Spain thinking you are just passing through, maybe enjoying Barcelona cafes or Madrid evenings, and suddenly the tax office decides you live here for real, which means Spain now wants a share of almost everything you earn anywhere in the world. This usually happens not because you signed some dramatic document, but because you stayed a little too long, or because your life quietly rearranged itself around Spain without you noticing. And that is exactly how income tax in Spain, known as IRPF, starts eating your income if you are not prepared. My name is Hector, and I help people understand how European tax systems actually work in real life, not how they are vaguely described on government websites. The problem is not that Spanish taxes exist, because every country taxes income, but that most people become Spanish tax residents by accident and only realize it when a letter arrives, or when an accountant tells them they owe tens of thousands in back taxes, penalties, and interest. This is expensive, stressful, and completely avoidable if you understand two ideas that Spain uses to decide whether you are taxable here, and how IRPF then applies to your salary, freelance work, and rental income. Stay until the end, because once you understand how these rules combine, you will see exactly where the biggest traps are and how people legally reduce the damage before it is too late. The problem is not that Spanish taxes exist, because every country taxes income, but that most people become Spanish tax residents by accident and only realize it when a letter arrives or when an accountant tells them they owe tens of thousands in back taxes, penalties, and interest. This is expensive, stressful, and completely avoidable if you understand two ideas that Spain uses to decide whether you are taxable here and how IRPF then applies to your salary, freelance work, and rental income. Stay until the end, because once you understand how these rules combine, you will see exactly where the biggest traps are and how people legally reduce the damage before it is too late. Spain decides whether you are a tax resident using two main tests, and the first one is the famous 183-day rule, which sounds simple, but catches more people than any other rule in Europe. If you spend more than 183 days in Spain during a calendar year, Spain considers you a tax resident for that entire year, which means from January 1st to December 31st, not just the days you were physically present. The dangerous part is that these days do not have to be consecutive, so bouncing in and out does not help if the total crosses that threshold. What makes this worse is that Spain does not just count full days the way a hotel might, because partial days can count, and travel days often count, which means people who think they are at 170 or 180 days suddenly find themselves over the line. Once that happens, Spain does not tax only Spanish income, but your worldwide income, including salaries paid abroad, freelance clients in other countries, dividends, interest, and even rental income from properties outside Spain. Now here is where many people think they are safe, because they stayed under 183 days. But Spain has a second rule that is even more dangerous, called the Center of Vital Interests. This rule allows Spain to treat you as a tax resident even if you stayed fewer than 183 days, simply because your life is effectively based there. If your main economic activity is in Spain, or your spouse and children live there, or your business is managed from Spain, the tax authorities can argue that Spain is where your life is centered, and therefore Spain gets taxing rights. This is where digital nomads, remote workers, and entrepreneurs get burned, because you might think you are just visiting. But if your clients, bank accounts, apartment lease, and daily routine are all Spanish, the argument becomes very easy for the tax office. In practice, this means you can be taxed as a resident even when you honestly believed you were a non-resident. Once you are classified as a Spanish tax resident, IRPF applies, and IRPF is not a flat tax, not a simple tax, and definitely not a gentle tax. It is progressive, which means the more you earn, the higher the marginal rate becomes, and those rates climb quickly compared to many other countries. IRPF starts at 19% on the first slice of income and rises through several brackets until it reaches 47% at the top, depending on the region where you live. This means that for higher earners, nearly half of the last euro earned goes straight to the tax authorities before Social Security is even considered. To make this real, imagine a regular employee earning a salary of 40,000 euros per year in Spain. The first portion of that income is taxed at the lowest rate, then the next portion at a higher rate, and so on, until the top slice reaches rates above 40%. People often hear 40,000 and assume they will pay 40% on all of it, which is not true. but the blended result is still painful. After income tax and mandatory Social Security, the net amount is often far lower than newcomers expect, especially if they compare it to countries with lower overall tax pressure. Freelancers and self-employed people feel this even more aggressively because Spain taxes freelance income through IRPF as well, but with fewer protections and more cash flow pressure. As a freelancer, your profit is added to your general taxable base, which means it is stacked on top of any other income you have, pushing you into higher brackets faster. On top of that, you are required to make advance payments throughout the year, often quarterly, based on expected income rather than actual cash in your bank account. This creates a situation where a freelancer earning, for example, 60,000 euros in gross income may feel rich on paper, but after deducting expenses, paying Social Security, making advance IRPF payments, and settling the final tax bill, the net result can be shockingly low. Many people realize too late that their effective tax rate is closer to 35 or 40% once everything is combined. Rental income is another area where people underestimate how IRPF works in Spain. If you own property and rent it out, whether in Spain or abroad, that income is taxable for Spanish residents. The rental income is added to your general taxable base after deducting allowable expenses, such as maintenance, repairs, and certain costs related to the property. However, depreciation rules are strict, and not all expenses you expect are deductible, which increases the taxable amount. For long-term residential rentals in Spain, there can be reductions on the taxable portion, but these rules are specific and change often, and they do not apply to short-term tourist rentals in the same way. For people who own property abroad, the surprise is that Spain still wants its share, even if you already paid tax in another country, which is where double taxation treaties come into play. But those treaties do not mean zero tax, only relief from being taxed twice on the same income. The biggest mistake people make is looking only at the headline tax rates and not at how income stacks together. Salary, freelance income, and rental income are often combined into one taxable base, which means adding a side hustle or buying a rental property can push your entire income into higher brackets. What looked like a smart financial move suddenly increases your overall tax burden far more than expected. This is also where many people forget that Spanish regions have their own variations of IRPF, which means living in Madrid can result in a different tax bill than living in Catalonia or Valencia, even with the same income. People move apartments without realizing they also moved into a different tax reality. If this sounds overwhelming, that is because it is designed to be complex, and complexity is expensive when you misunderstand it. The tax office does not warn you gently when you cross a threshold, or when your situation changes, and by the time you find out, the clock has already been ticking. If you are still watching, this is the moment where most people either continue guessing or decide to get serious, because understanding your tax residency status and modeling your income under IRPF before the year ends can save you thousands. This is exactly why professionals exist in this space, not to magically eliminate taxes, but to structure income, timing, and residency correctly so you do not pay more than the law requires. If you want a clear picture of whether Spain sees you as a tax resident, how your specific income streams will be taxed, and what legal options exist to reduce the impact before it becomes irreversible, this is where working with a qualified tax advisor pays for itself very quickly. Because once the year closes, your options shrink dramatically. Most people only learn how IRPF really works after it has already taken a bite out of their income. And by then the lesson is expensive, stressful, and impossible to undo, which is why the smartest move is understanding it now, while your decisions still matter. Because once Spain decides you are a tax resident, the tax bill does not ask whether you are ready for it.